Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. Here's something that drives me crazy. I see Singaporean investors every day making the same mistake. They hunt for cheap stocks like they're shopping at a Bugis Street bargain sale. They see a low PE ratio and think they've struck gold. But here's the shocking truth. Most of these cheap stocks are actually expensive mistakes waiting to happen. Today, I'm going to share 7 game-changing insights that will transform how you hunt for real value on the SGX. These aren't just theory. These are practical strategies that can make or break your CPF and SRS investments. By the end of this video, you'll know exactly how to spot genuine bargains from dangerous value traps. Here's what we're covering today. First, why low PE ratios can be your worst enemy. Second, the 3 types of low PE stocks you need to know. Third, the real estate red flags dominating SGX right now. Fourth, why DBS Group might be your best bet for steady income. Fifth, the REIT reality check that could save your portfolio. Sixth, the cyclical trap that's fooling Singapore Airlines investors. And seventh, your complete action plan for 2025. Let's dive in. Point 1, why low PE ratios can be your worst enemy. Think about this. You're walking through Orchard Road and you see a Rolex for $50. Do you buy it immediately? Or do you wonder what's wrong with it? That's exactly what a super low PE ratio should make you think. The PE ratio tells you how much you're paying for each dollar a company earnings. A PE of 10 means you pay $10 for every dollar the company earns. Sounds simple, right? But here's where most investors go wrong. They think lower is always better. That's like thinking a cheaper HDB flat is always a better deal, even if it's next to a construction site. Point 2, the 3 types of low PE stocks you need to recognize. First are value stocks with PE ratios between 5 and 15. These are mature companies the market has overlooked. Think of them as established HDB estates in good locations that haven't caught up to market prices yet. Second are value traps with PE ratios between 1 and 8. These companies have real problems. Declining industries, massive debt, or management issues. They're like those cheap condos with major structural problems. Third are cyclical bottoms with PE ratios between 3 and 12. These are companies in cyclical industries hitting temporary lows. Time them right and you win big. Time them wrong and you lose everything. Point 3, the real estate red flags dominating SGX right now. Look at our current top 5 low PE stocks. Landlord sits at number 1 with a PE of just 2.51. Synonymous Land comes in second at 625. Both are real estate developers with heavy China exposure. This isn't coincidence. It's a warning signal. China's property market has been in structural decline since 2021. The government implemented strict regulations on property developers. Landlord's debt-to-equity ratio has jumped to 89%. Their cash flow from operations turned negative in 2024. Pre-sales dropped 45% year over year. These aren't temporary setbacks. These are fundamental problems that make these stocks classic value traps. Now that we've covered the major red flags, let's pivot to a genuine opportunity. For even more detailed charts, deeper dives into the data, and a full written breakdown of today's topic, make sure to check out our Substack. The link is right there in the description. Point 4, why DBS Group might be your best bet for steady income. DBS trades at a PE of 11.88. That's reasonable for a quality bank. But here's what makes it special. DBS offers a 5.35% dividend yield with a sustainable payout ratio of 56%. That's real cash in your pocket every quarter. Think of DBS like the reliable uncle in your family. He's not flashy, but he pays his bills on time and always has money when you need it. DBS operates across Southeast Asia with strong positions in Singapore, Hong Kong, India, and Indonesia. Their return on equity is 14.2%. Their cost-to-income ratio is just 43.8%. These numbers show a well-run business that can weather economic storms. For CPF and SRS investors, DBS fits perfectly. The dividend yield provides steady income while you wait for capital appreciation. The bank's regional diversification gives you exposure to ASEAN growth without the volatility of individual country bets. Point 5. The REIT reality check that could save your portfolio. Capitaland Ascot Trust trades at a PE of 7.57. It operates hotels and serviced residences across Asia Pacific and Europe. The distribution yield is 6.8%. Sounds attractive, right? But here's the catch. REITs are sensitive to interest rates. When rates rise, property values fall and borrowing costs increase. The trust's debt-to-assets ratio is 38.5%. That's manageable, but not great in a rising rate environment. Occupancy rates are recovering, but still below pre-pandemic levels. Service residences are at 82%, student accommodation at 91%, and hotels at just 75%. The key lesson? Don't just look at PE ratios for REITs. Focus on distribution sustainability, occupancy rates, and debt levels. A low PE means nothing if distributions get cut. Point 6. The cyclical trap that's fooling Singapore Airlines investors. Singapore Airlines trades at a PE of 8.39. The company just posted a net profit of 2.8 billion SGD. Sounds great, right? But here's what the numbers don't tell you. That profit included a 1.1 billion SGD one-off gain from the Air India Vistara merger. Operating profit actually declined 37.3% due to higher expenses. Airlines are cyclical businesses. Today's record profits often become tomorrow's losses when fuel prices spike or travel demand drops. Singapore Airlines is a great company, but we might be at the wrong time in the cycle. Current profits reflect post-pandemic recovery that may not sustain. Fuel costs are up 15% in 2025. Business travel remains 20% below pre-pandemic levels. These factors suggest caution despite the attractive PE ratio. Point 7. Your complete action plan for 2025. Here's your step-by-step framework. First, screen for low PE ratios under 15. Second, investigate why the valuation is low. Third, assess financial health through debt levels, cash flow, and margins. Fourth, evaluate industry dynamics including growth, competition, and regulation. Fifth, consider timing based on cyclical position and market sentiment. For CPF and SRS investors, I recommend a 40% allocation to DBS Group for core banking exposure. Add 20% to Singapore Airlines, but only buy on dips. Include 15% in Capitaland Ascot Trust for income generation. Keep 25% in cash and bonds while waiting for better opportunities. Avoid Chinese property developers unless you're an expert who can stomach 50% volatility. Focus on sustainable dividends over high yields. Remember, successful value investing isn't about finding the cheapest stocks. It's about finding quality companies trading below their true value. Now for Iggy's personal take. After analyzing hundreds of SGX stocks over the years, I've learned that patience beats speed every time. The 5 stocks we discussed today represent different risk-reward profiles. DBS Group offers the best combination of value, quality, and income for most Singaporean investors. The real estate developers present significant risks that outweigh their apparent cheapness. I've seen too many investors get burned chasing ultra-low PE ratios in declining sectors. Singapore Airlines and Capitaland Ascot Trust fall somewhere in between. They require careful timing and position sizing. My direct advice? Start with DBS Group if you want steady income and reasonable growth prospects. Use it as your core holding while you wait for better opportunities in other sectors. Don't chase the lowest PE ratios. Instead, focus on sustainable business models with competitive advantages. The SGX offers plenty of opportunities for patient investors, but success requires discipline and a comprehensive understanding of business fundamentals. Use PE ratios as a starting point, not the final decision maker. So, we've broken down value investing on the SGX, and I've given you my personal take on how it applies to your journey here in Singapore. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today.